fresh data just hit the wires, and it's not minor. The Shanghai Futures Exchange, SHFE, has officially confirmed that starting on the final trading day of February, any participant without approved hedging quotas will receive zero delivery allocation on all silver contracts. Not reduced, not limited, zero. This isn't market gossip. It isn't speculation floating around on trading forums. This is an official exchange-level policy decision. And exchanges don't make moves like this unless something serious is happening behind the scenes. Restricting delivery access is an extreme step, and historically, exchanges only tighten delivery rules when physical supply pressure becomes impossible to ignore. Let me be absolutely clear about something before we go further. I'm not here to sell you anything. I never will. No paid trading signals, no mentorship groups, no secret courses, no investment pools. Nothing. If someone online is using my name or branding trying to sell you financial products, subscriptions, or insider access, that's a scam. Report it immediately. These videos exist for one reason. Information matters. Understanding what's happening matters. This is about financial awareness, not financial advice, not hype, not a sales funnel. Protect your own capital. Verify every claim you hear, including mine, and stay far away from anyone promising easy money. Easy money usually ends up being very expensive lessons. Quick update for viewers who may have missed the last uploads. We talked about how this channel's reach has recently been suppressed, likely due to algorithm limitations or shadow restrictions. If you didn't catch those videos, go back and watch them so you understand the situation. More importantly, a backup channel is now live, and new content will begin appearing there within hours. The handle is Odjanag_2, and you'll find the link in the description. Right now, there are 0 videos uploaded, and that's intentional. That's how you know it's the legitimate backup channel. Every other account using a similar name is a copycat trying to take advantage of confusion. Verify before subscribing to anything. If this main channel ever faces stronger suppression, the backup becomes the safe vault where the conversation continues, and censored, direct, and deeper. So make sure you know where to find it. And if these breakdowns help you understand what's happening in markets, drop a comment. Yesterday, tens of thousands of viewers pushed back against algorithm suppression with engagement that couldn't be ignored. That collective response matters more than people realize. A simple comment lets me know you're actually here, actually watching, and actually paying attention. Now let's get back to the numbers. At the moment I'm recording this, here's how prices line up. Western silver spot pricing sits around $85.90. Futures slightly lower around $85.40, while Shanghai spot pricing translates closer to $89.67, and Shanghai futures push even higher near $92.29. That creates roughly a $3.70 to $3.80 premium for silver trading in Eastern markets compared to Western contracts. Same metal, different pricing worlds. This data isn't hidden. Anyone can check Shanghai exchange pricing directly. It's publicly available for those willing to look. Now consider what just happened over the past 12 hours. Silver surged again, adding roughly 7 to 8% in value, which translates to nearly $300 billion added to market capitalization in a matter of hours. Even more striking, silver has rebounded roughly 35% from last week's overnight lows in only 5 trading days. That kind of move in such a short window signals intense volatility beneath the surface. At the same time this violent rebound was happening, SHFE suspended 3 more trading account groups for violations today. That brings total suspensions on a major global futures exchange to 20 account groups in just 1 week. When was the last time you saw that happen? Exchange Regulation Article 16 outlines disciplinary actions publicly. Anyone can read it. But people who understand futures markets know that mass account suspensions usually indicate unusual trading activity or attempts to control extreme price behavior. Those who bother verifying these signals already understand what's unfolding. Those dismissing it without checking will eventually learn, likely when prices are much higher. Meanwhile, another important data point, roughly 861,000 ounces of silver left COMEX vault inventories in a single day. March delivery contracts are being closed or rolled forward at increasing speed. If this pace continues, March deliveries might still be covered. But that outcome depends heavily on how many participants actually demand physical delivery versus rolling contracts forward. Current open interest stands around 68,000 contracts, representing roughly 340 million ounces of silver claims. Yet registered silver available for delivery in vaults sits near 101 million ounces. That's a 3.4 to 1 paper-to-physical coverage ratio, meaning more than 3 paper claims exist for every ounce available. Again, this is not secret data. COMEX updates inventory numbers daily. Anyone can confirm. Open interest also dropped by roughly 2,000 contracts recently, suggesting some short positions are covering, but nothing yet indicates delivery pressure has fully eased. At the same time, mainstream media coverage is beginning to quietly acknowledge supply stress. Bloomberg reported strong precious metals demand in Hong Kong ahead of Lunar New Year, with retail buyers snapping up small bars and coins. Sounds like typical holiday demand, right? But buried within that coverage was a crucial detail. Bloomberg specifically mentioned supply constraints, particularly in silver, raising concerns about whether current momentum can be sustained. That matters because this isn't coming from fringe blogs or conspiracy channels. This is mainstream financial media admitting supply pressure exists, just not highlighting it loudly. People who read beyond headlines noticed. Bloomberg also recently published analysis covering China's ongoing silver squeeze, confirming pressure in Eastern markets has not disappeared even as prices stabilize temporarily. At the same time, analyst David Jensen released fresh research indicating Western silver vault inventories are declining rapidly, while lease rates surge across U.S. and London exchanges. His conclusion? Physical metal continues flowing east, and global vault inventories are draining simultaneously. Combined with decades of underproduction and growing industrial demand, replenishing supply would likely require significantly higher prices. And his warning on volatility was blunt. The price swings we've seen so far may only be the beginning. Those who study this data early position themselves accordingly. Most people wait until major financial networks simplify the story for comfort, usually after large moves already occur. And this is where the bigger geopolitical picture starts to connect. Now step back and look at the geopolitical shift unfolding behind these market moves, because metals pricing doesn't exist in isolation. It sits right in the middle of global power dynamics. China's share of U.S. imports has now dropped to levels not seen in over 2 decades, 26 years. For the last 5 years straight, both countries have been slowly but steadily unwinding economic dependence on each other. So the idea that tariffs alone could economically cripple China doesn't hold the same weight anymore. China has already been restructuring supply chains, expanding trade partnerships, and reducing reliance on U.S. demand. And while that decoupling continues, look at what China is doing with strategic commodities. Export controls on key industrial metals, stockpiling behavior, and pricing power shifting eastward. The Shanghai premium we're seeing in silver, nearly $4 higher than Western pricing, isn't random. It signals something critical. Physical metal is increasingly valued differently from paper contracts. In simple terms, when buyers in one part of the world consistently pay more for actual metal than futures markets price elsewhere, it suggests physical supply is tighter than derivative markets imply. Anyone can track Shanghai Gold Exchange pricing daily. This data isn't hidden. Now compare silver and gold dynamics. Economically speaking, estimates suggest the available silver supply relative to gold sits somewhere around a 1:100 ratio. Yet modern society depends on silver in ways gold simply isn't. Solar panels, electric vehicles, data centers powering AI expansion, 5G infrastructure, military hardware, all require silver. And consumption continues rising faster than mining output can replace it. So the shift into silver isn't just because gold prices have climbed. Investors and industries alike recognize silver offers both industrial demand and monetary characteristics, making its upside potential more explosive during supply stress. And here's where the disconnect grows more obvious. The number printed on a New York trading screen isn't necessarily the true price of silver. The real price is determined when someone demands physical delivery, and exchanges must actually produce metal, not paper contracts. That's exactly what these Shanghai premiums, delivery restrictions, and vault inventory declines are exposing. Paper contracts can be created endlessly. Physical metal cannot. When exchanges start limiting delivery allocation, markets are quietly admitting that supply pressure exists. At the same time, institutional messaging looks confused. Bank of America recently flagged metals and certain equity markets as displaying bubble-like behavior using their new risk indicator model. They're warning about frothy market conditions fueled partly by AI-driven speculation. At first glance, that sounds like a sell signal. But in the very same week, Wells Fargo raised their gold price targets for 2026 to somewhere between $6,100 and $6,300 per ounce, more than 20% upside from current levels. Their reasoning? Rising geopolitical tension, ongoing market volatility, and continued central bank buying. They also described recent pullbacks in gold as healthy corrections rather than signs of a market top. So within days, two major banks sent completely opposite messages. One warns of bubbles, the other highlights long-term upside. That contradiction tells you institutions themselves are uncertain about what phase we're entering. To answer whether this is a bubble or breakout, you need to zoom out. Over roughly the past 25 years, gold has dramatically outperformed the S&P 500 when measured in real terms. That means despite decades of innovation, productivity gains, and corporate expansion, equity markets have underperformed a metal that simply sits in vaults doing nothing. No earnings growth, no innovation, no expansion, just scarcity and monetary demand. At the same time, equity earnings yields now hover near levels last seen during the dot-com bubble era, periods historically associated with expensive valuations. So perhaps the bubble isn't necessarily in metals. Perhaps the bubble sits within financial assets priced in currencies that continually lose purchasing power. And silver, due to tighter supply and dual industrial monetary demand, tends to exaggerate moves when gold trends upward. That explosive 35% rebound in 5 days is a reminder of how violent silver swings can become. But intellectual honesty requires presenting the bearish side too. Silver lease rates, which recently showed extreme spikes between 4 and 6% daily moves, have now fallen back closer to around 2.7%. Rapid lease rate shifts sometimes signal short-term dislocations rather than lasting shortages. There's also a real possibility March COMEX deliveries proceed smoothly if enough contracts roll forward rather than demanding physical metal. Markets have faced delivery scares before that ultimately resolved quietly. And while Shanghai premiums remain elevated, they've been higher during past cycles. So current conditions, while notable, aren't unprecedented. Bank of America's bubble warnings also shouldn't be dismissed outright. Markets that move too fast can correct sharply even when fundamentals appear strong. Momentum works both directions. Prices can overshoot reality on the way up just as easily as they undershoot during panic. And history shows paper markets have repeatedly suppressed or redirected price discovery through derivatives, short positions, and coordinated actions that can last far longer than traders expect. The 2020 J.P. Morgan Precious Metals Manipulation Settlement, costing nearly $1 billion, proved manipulation occurred. But it also proved manipulation can continue for years before consequences arrive, and markets move on afterward. So if someone expects instant justice where price discovery suddenly becomes fair and transparent, they may be disappointed. Paper markets can stay dominant longer than traders can remain solvent. But here's the key assumption behind all bearish scenarios, that paper markets continue controlling price discovery. And that assumption is exactly what current signals suggest may be changing. Delivery restrictions, vault depletion, account suspensions, and persistent price premiums in physical markets all point toward growing separation between physical supply and paper pricing mechanisms. You can create infinite paper contracts. You cannot create infinite physical silver. And when more participants demand real metal instead of cash settlement, the derivative pricing structure becomes harder to maintain. That's the shift many analysts believe is now developing. Now let's bring in another perspective that's gaining attention among macro investors: the long-term currency and debt scenario. Daniel Oliver of Myrmikan Capital recently laid out a case suggesting gold could eventually reach levels above $12,000 per ounce under extreme dollar stress scenarios. His argument isn't built on hype. It's based on basic monetary math. His thesis is simple. Governments facing unsustainable debt burdens eventually face two choices: Either they default on obligations, or central banks step in and effectively monetize debt by buying government bonds at massive scale. Default damages credibility. Monetization damages currency value. Neither path is painless, but history shows governments almost always choose currency debasement over outright default because it spreads pain more gradually and politically quietly. Whether or not one agrees with Oliver's exact price target, the broader point is harder to dismiss. Debt trajectories and expanding central bank balance sheets continue pushing global currencies into fragile territory. And silver sits directly in that conversation. Unlike gold, silver carries dual demand pressure. It's both monetary and industrial. Solar installations, EV expansion, semiconductor production, AI infrastructure, and defense technologies all consume silver in ways that permanently remove supply from circulation. Much of that silver isn't economically recoverable after use. It's dispersed in electronics and industrial components rather than stored in vaults. So when monetary demand rises at the same time industrial demand remains strong, supply stress compounds quickly. And historically, silver doesn't just follow gold. It often outpaces gold in percentage terms once momentum builds. That leverage effect explains why silver moves tend to feel explosive compared to gold's steadier climb. Which brings us back to current conditions. Right now, COMEX registered silver sits around 101 million ounces, while open interest represents claims exceeding 340 million ounces. SHFE delivery restrictions begin at the end of February for participants without hedging quotas. Mainstream outlets are acknowledging supply tightness. Analysts warn volatility hasn't peaked. Institutional banks disagree publicly on whether metals represent bubbles or buying opportunities. Add to that a pattern many commodities traders have noticed for years. Prices often rally during Asian and European trading hours only to fall sharply once New York trading begins. For a long time, it appeared Western derivative markets could consistently push prices lower during U.S. hours. But lately, cracks in that pattern have begun to show. The Shanghai premium exists precisely because Eastern buyers continue purchasing physical metal regardless of Western paper pricing pressure. If suppression mechanisms lose effectiveness, price discovery begins shifting where real demand exists. So what should observers actually monitor going forward? Watch how SHFE delivery rules affect physical flows once implemented. Watch March COMEX delivery activity closely. Watch daily Shanghai premiums. Monitor lease rate volatility. These signals reveal whether physical supply truly tightens or if markets stabilize back into normal trading patterns. All this information is publicly accessible. Exchange inventory reports update daily. Pricing data is transparent. News coverage is searchable. No secret sources required. And here's the key difference between informed participants and everyone else. Some people read headlines and move on. Others dig into actual reports, inventory numbers, and exchange announcements. They verify claims themselves. Those doing the homework understand why 20 account suspensions in 1 week matter. They understand why coverage ratios become important when delivery pressure increases. They see signals forming before price headlines catch attention. Those waiting for television networks to simplify the narrative will usually enter markets after major moves already occur. The information is already available. The only question is whether individuals choose to look. But before anyone gets carried away, balance matters. Markets don't move in straight lines. And there are still legitimate risks that could slow or reverse momentum. For example, lease rates falling could indicate short-term easing in stress. Contract rolls might reduce delivery pressure. Central banks and large institutions still hold enormous influence over financial systems. And remember, manipulation or coordinated intervention can persist far longer than traders anticipate. Markets don't reward emotion. They reward patience, discipline, and risk management, which leads directly into the final point: how to think about all of this without getting swept up in hype or fear. So here's the bottom line, the part that actually matters once all the headlines, price swings, and market noise are stripped away. Markets move in cycles. They always have. Periods of complacency give way to volatility. Volatility gives way to opportunity. Opportunity eventually gives way to excess, and excess gets corrected. Every asset class goes through that process. Right now, silver and precious metals are sitting at the center of a massive debate. One side argues we're witnessing the early stages of a supply-driven breakout where physical scarcity begins overpowering derivative pricing mechanisms. The other side argues this is simply another volatile phase within markets that remain controlled by paper trading and institutional power. Both sides present arguments supported by data, and both scenarios remain possible. What separates successful market participants from everyone else isn't guessing correctly every time. It's managing risk well enough to survive uncertainty. Because here's the uncomfortable truth. Markets can remain irrational longer than most people can remain financially solvent. Prices can fall even when fundamentals look strong. Prices can rise even when fundamentals look weak. No analyst, influencer, or institution knows the future with certainty. And that's why independent verification matters more than ever. Don't rely solely on commentary, including mine. Check exchange data yourself. Read primary reports. Look at vault inventories, delivery statistics, lease rates, and policy changes firsthand. When people base decisions purely on hype, emotion takes over. Fear of missing out leads to chasing tops. Panic leads to selling bottoms. That emotional cycle destroys capital far more often than market manipulation ever does. Meanwhile, disciplined investors think differently. They prepare for multiple outcomes. They avoid leverage they can't survive. They protect capital first and seek opportunity second. And remember something critical. Physical supply and paper markets don't have to break tomorrow, next week, or even this year. Structural shifts take time, sometimes years. JP Morgan's manipulation case proved that distortions can persist for decades before consequences show up. Markets often correct slowly, then suddenly. So expecting immediate price explosions or overnight transformations is usually unrealistic. Patience matters, but patience doesn't mean ignoring signals either. When exchanges begin adjusting delivery rules, when vault inventories drain globally, when mainstream outlets cautiously acknowledge supply pressure, and when price premiums appear across regions, those developments deserve attention. Not panic, not blind optimism, just attention. Because at the end of the day, investing isn't about joining crowds. It's about understanding probabilities and positioning yourself so that you're not forced into bad decisions when volatility arrives. And volatility always arrives. So whether silver explodes higher, trades sideways for months, or corrects sharply before moving again, the winning approach stays the same. Use logic, not emotion. Do your homework. Verify sources. Protect your capital. Avoid promises of easy money. Because in markets, easy money usually turns out to be the most expensive lesson. The data is public. The signals are visible. The choice is personal. Are you someone who checks the facts and thinks independently, or someone who waits until everyone else agrees before acting? Either way, the next phase in this metal story is already unfolding. Stay alert, stay rational, and invest with logic, not hype.